Warren Buffett once said, "For investors as a whole, returns decrease as motion increases." In other words, the more you're fiddling with your portfolio and trading in and out of different investments, the less money you're going to make. For a lot of areas in life, the statement of "don't just stand there, do something" is great advice. But according to legendary Jack Bogle, the way to wealth with investing is by doing the opposite. Don't do something, just stand there. To be able to just stand there and not do anything, you need to feel comfortable and confident about what you are investing in and how much you have invested into each holding. I'll show you how to allocate your money in a way that'll give you a better chance of buying and holding for the long term. What we're basically talking about when it comes to how much is your asset allocation. This is a predetermined plan for what percentage of your money you want spread across different asset classes. Think stock-based funds, bonds, cash, commodities, real estate, and things like that. How you have your money allocated across those different investments is important because it's going to determine your returns, how much work you have to do, and what to do with the next dollar that you invest. Now, while everyone in theory wants to get the highest returns possible, it is not always worth chasing. There is no free lunch, so if you want to chase those higher returns, then you have to take on additional levels of risk. Successful investing over the long term is 50% math and 50% behavior. This means that you're going to want to find a nice balance between risk and return. It's not about what's possible, it's about what's probable. It's possible for you to win the lottery, but it's not very probable. The same goes for investing in the stock market. Unfortunately, all we hear about are the people who have 10x'd their money in a very short period of time. So we assume that it's possible for us to do the same thing in a very simple way. The truth is that everyone loves to talk about their wins, but you very rarely hear about the losses from taking on too much risk, which is a whole heck of a lot more common. You didn't hear from the 5 people that I talked to who combined lost more than $200,000 following stock picking YouTube channels. You definitely need to accept some level of risk with investing, or else your money is never going to grow, which will put your future self in a very horrible position when it comes to retirement. The first important part when determining your asset allocation is figuring out the level of risk you're willing to take. Your risk level will be obvious based on the stock and bond mix that you hold. To simplify the two sides of the coin, allocating money to stock-related funds assumes a higher level of risk with a higher potential return because at a basic level, you're investing in the future success of those companies, which isn't always guaranteed. Allocating money into bonds assumes a lower level of risk with a lower expected return because they are guaranteeing you a specific payment ahead of time. When you combine stocks and bonds together, you get diversification from a risk-return perspective because both asset classes aren't highly correlated. Using a stock and bond strategy helps to minimize the risk of losses because when one asset is declining in value, others in the portfolio may either be increasing in value or not declining as much. In reality, it's extremely difficult to find two asset classes that are 100% uncorrelated 100% of the time. Now, this isn't a reason to admit defeat when it comes to diversification, but it is something to be aware of. For example, you'd think that stocks and bonds were 100% uncorrelated. But over the past couple of years, when stocks have fallen, so have bonds. While this is true, bonds haven't dropped in value at the exact same rate, so they've technically still given the investor a level of protection. Here's the same chart I just showed you, but I added some diversification. A portfolio with an allocation of 80% stocks and 20% bonds. The drawdowns aren't as extreme as a 100% stock allocation, but they're not as stable as a 100% bond allocation. When we diversify and adjust for risk, the returns for something like an 80-20 portfolio is better than 100% stocks. Diversification isn't just important when it comes to the stock and bond mix, it's also important when we dig deeper into the types of stocks and bonds that you hold as well. With stocks, diversifying in companies outside of your home country is something to think about. While a lot of US-based companies make money outside of the country, that's not always enough to be fully diversified across the world. So when it comes to diversification, these are the main things that you need to know. Number one, everything is going to be at least a little correlated. Number two, there are going to be short periods of time where assets seem to be correlated, but over the long term, that correlation is reduced. Diversification reduces risk and increases returns over long periods of time. By returns, I am referring to risk-adjusted returns. And number 4, diversification is for people who are playing the long game and not looking to play the get-rich-quick game in the stock market. The third important aspect of asset allocation is rebalancing. An occasional adjustment to your portfolio will make sure the allocation of your assets stays relatively close to the target percentages that you set in advance. There's 2 ways this can be done. Number 1, through regular contributions if you are in the accumulation phase of investing. And or number 2, by selling off overperforming investments to purchase the underperforming investments so that you can get back to your target allocation. If you're going with number 2, then a once per year rebalance is more than enough. I personally wouldn't say to do it any more than that. There's 3 big reasons why rebalancing is so important. Number 1, because it increases long-term returns while reducing risk. Number 2, if you don't rebalance, then you'll most likely end up with an all-stock portfolio since the expected returns on those is higher than bonds. And number 3, if you hold a US and international stock fund, then over time, one will naturally outperform the other. By not rebalancing back to the target allocation, you might be reducing your overall diversification. Before I tell you about the biggest myth with how you invest your money, please help support my little dog Molly and the free content on this channel by hitting that thumbs up button and sharing the video. I'm going to give you some example portfolios, but first I need to call out one very important thing when it comes to choosing the best asset allocation. There is no magical perfect way to spread your money across all of the funds that you invest in. Don't feel bad about that though, because no one can do this since we cannot predict the future. We can only determine what the best portfolio was when we look back into the past. Here's a quick snapshot of how different asset classes have performed over the past few years. Trying to predict what will perform well or basing your decision on previous year's winners is a loser's game. Your job as an investor is to find an allocation that will do reasonably well under a wide range of circumstances. And the way to do that is to buy and hold a globally diversified portfolio so that you can benefit from anything and everything that happens to do well that year. Behaviorally, it's also going to be important to pick an asset allocation that you can 100% stick to during the good and bad times. That's way more important than trying to find the tooth fairy of allocations with the highest returns. You're better off building an okay portfolio with reasonable returns that you'll stick to versus the perfect portfolio with super high expected returns that you won't because you've added way more risk than you can handle. Over short periods of time, your stock allocation matters a whole heck of a lot. But for us long-term investors, it's less important to get the percentages dialed in perfectly. All right, so I'm going to give you a few different portfolio options when it comes to asset allocation, going from a very simple approach to a more complicated approach. First, if you just want a completely hands-off approach, then you can go with either a target date fund or a life strategy fund from Vanguard, where they've already chosen the allocation mix for you. Pro tip, don't hold these types of funds in taxable investment accounts. Only tax advantage accounts. The next level is going to be to build something like a 2 or 3 fund portfolio. Either of these portfolios will work for someone who is in the accumulation phase of investing. To be transparent, I'm biased towards the 2-fund portfolio right now and will eventually switch to the 3-fund portfolio when I get closer to retirement. You'll hear a lot of people, including myself, say that young people holding bonds doesn't really make sense since that is the perfect time to bear as much risk as possible for the highest potential return possible. But if behaviorally you don't think that you can handle the wild swings that come with a 100% stock-based portfolio, then don't feel bad about going with a 3-fund portfolio where you allocate at least a little bit of money towards bonds. As I'll continue to repeat, you want to build a portfolio from the very start that you can stick to through thick and thin. The next example portfolio is from a book called The Intelligent Asset Allocator. I highly recommend it if you want to nerd out and go a little bit deeper into asset allocation. As you can see, it gives you a little bit of everything split up into individual funds. The author calls this his level 1 portfolio since it's pretty simple and easy to manage. Not as simple as the 2 or 3 fund portfolios, but it's the next step up from them. The level 2 portfolio the author mentions breaks his first portfolio down into even more specific slices. Keep in mind that the more funds you choose to add, the more work you have to do. Do not choose this type of portfolio if you're not willing to manage it. Here's the author's comments about the level 2 portfolio. This portfolio is for the individual who is serious about diversification and wants its full benefits. You may wish to add other asset classes as well, such as precious metals, stocks, and international bonds. Adding more funds beyond what he has listed in this second portfolio is what he calls level 3. I agree with his comment in the book about the fact that this portfolio is only for people who truly enjoys investing and who has the time and patience to deal with the complexity. In that same book I just mentioned, the author gives a good rule of thumb chart that I'll put on screen. Now, it might help you decide for yourself how you want to allocate your money. Vanguard also has a helpful chart to show you how different portfolios have performed in the past. I'm not a big fan of using past performance when it comes to choosing an asset allocation, so I'd recommend using this chart to focus more on the worst annual gain section. Go through each one and ask yourself, if I held each of these allocations, then could I handle this type of decline based on my risk tolerance and how long until I needed this money to live off of? If you had $1 million or 5 years from retirement and held a 100% stock portfolio, could you handle that type of decline? Your $1 million would turn into $570,000, which would be devastating to you being able to recover in time to actually retire in 5 years. A person who has more than 20 years until retirement can handle a large decline like that because A, they have more time to recover, and B, they'll most likely continue investing more money at lower prices. When it comes to how much to allocate to international stock holdings, I've seen recommendations from experts range from 15 to 25% during the accumulation phase of investing. As you enter retirement, I've seen some experts suggest dropping down to 15%, then back down to 10% at some point during retirement as allocations shift more towards bonds. These are only guidelines though, so remember that. You need to pick an allocation that you feel comfortable with. Like I mentioned earlier, it's impossible to pick the perfect allocation, so as long as you get it close enough, you're good to go. If you pick a certain allocation then realize that it doesn't work for you, then don't be afraid to change it. But you should not be taking cues as to what to do with your portfolio from outside influences like the stock market, the economy, or political events. It should only be adjusted based on your risk tolerance. Trust the process, ignore the noise, and continue investing. When you think about how you want your money allocated, you'll want to think about it in terms of all of your investments combined across all of your accounts. The problem is that this can be extremely difficult to do. The reality is that most of us have accumulated more accounts than I have ex-girlfriends. Multiple 401ks from different employers, Roth IRAs, HSAs, 457s, 403bs, and taxable investment accounts. Because of that, there's money everywhere in all kinds of different funds. That's why I created a little target allocation tracking spreadsheet that I'll share with you for free. It'll help give you a bird's eye view across all your accounts so that you can figure out where your asset allocation currently is and where it needs adjusted to get to the targets that you want. I'll have a link in the description to send you a free copy of this spreadsheet, as well as a private video where I walk you through more details on updating this file as time goes on. Hit that thumbs up button and share the video with someone you think needs to see it. Ways to help support this free content are down in the description below. I'll see you in the next one, friends. Done.